And for more on the corporate earnings from the tech world's top firms, I'm joined by Daniel Ives. He's Managing Director and Senior Analyst at FBR Capital Markets. Daniel, good to have you.
Great
Thanks
to be
for joining us. Well, let's start off with Apple. And Apple earnings did beat the street. This was Apple's smallest earnings per share beat in 2 years. However, the stock tanked initially in after hours, but now we're seeing it with the live after hour quote behind us recovering to about -1%, down 1%. What was your biggest takeaway from the report?
Yeah, I mean, they're the gold standard of technology. So them missing the whisper number where the street was looking for a 49 million iPhone, they came 47.5. That combined with the slightly softer than expected guidance, even though it's most likely conservative, I think that combo is really not what the bulls were hoping for, which is what you're seeing, this sort of knee-jerk reaction, especially as we're getting to this iPhone 6 product cycle. There's a lot of questions about China in terms of how long that could last.
But they did great in China. In fact, revenue more than doubled. They came in at $13.2 billion compared to $6.2 in the year-ago period.
And now the worry is China was in a stand-down. We ultimately believe that's really the high-octane fuel for Apple. But it's the fact that going forward in terms of the guidance, in terms of gross margins, as well as implied for the iPhone, that's really because they continue to be held to a different standard than other technology companies.
Daniel, a gross margin of 39.7%? What more would you want?
And look, as someone that's been a big bull on Apple, that's why we look at these knee-jerk reactions like we're seeing tonight and probably like we see tomorrow morning as opportunities, because the longer term we view it as a $1 trillion market cap. And I think also there's a lot of questions about the watch, and there's no numbers around that, and some were disappointed.
Well, they did sort of bundle the watch sales in with the other category, along with the iPod and Beats and Apple TV. Why?
I mean, at this point, it's still small in terms of the overall opportunity. Distribution was definitely a snafu coming out of the gates. I ultimately view it that once it's in retail, and Cook was pretty positive on the conference call, I think they do give that number out in the next two, 3 quarters once it gets bigger. But now we're looking at a trajectory of 12 to 15 million units for the year, whereas the bulls were thinking that could have been as high as 20 million.
Well, I want to talk a little bit about the iPhone, because it may be concerning that iPhone sales made up 63% of Apple's overall sales. iPad, well, they're basically slipping into down 18% per item. Is Apple becoming too reliant on the iPhone?
And that's the worry. I mean, that's really, after all this, it really comes down to the reason the watch and Apple Pay and all these other areas like streaming are so important. It's because it's how reliant they are on the iPhone. As we've seen with other technology companies, you know, from Nokia to Motorola and the list goes on, this is a little unique because we're talking about you know, a company that could really have this for the next 2-3 years in terms of ownership of this market. But that's why it's becoming less reliant on that iPhone, on the hardware business. That's not going to change near term, but that's why these other growth areas are so important to the stock in terms of the multiple, that investors could believe it's not just going to be a one-trick pony. 2-3 years from now, ideally, iPhone is less than 50% of revenue.
Let's focus on Microsoft. Speaking of Nokia, which you mentioned, that Nokia acquisition taking a big hit on Microsoft's bottom line there. Still, they did beat earnings if you disregard that. What was your overall take from that report?
Nokia and Nadella ripped the Band-Aid off in terms of that $7.6 billion write-down. And from day one, the New York City cab driver knew that that was a horrific acquisition. So it really comes down now to, can they be successful on cloud? Windows 10, what that could do to next year's growth. And I view it as a step in the right direction, stock down 4%. But I think ultimately this could be a stock with a 5 in front of it as they start to show a renaissance of growth on that Windows 10.
Well, since Nadella took over as CEO, Microsoft has shifted the focus, as you say, to cloud computing. How is this transition going? How is this reinvention shaping up in your opinion?
Yeah, I think for 18 months, in terms of CEO, you got to give him an A as a grade, just given that he's changed the organization to focus on cloud. But now the big challenge is they're still relying on a PC environment that's horrific in terms of down 12, 14%. And now they need to be successful in mobile. That's going to be the Everest-like climb. And now ultimately they're going to do more acquisitions. They're going to become more focused on cloud. But it all comes down to Windows 10. Windows 10 is ultimately going to be the flagship cloud-centric platform that takes Microsoft into its next phase of growth.
But that's also still dependent on PC sales to a degree.
Near term it is, but ultimately they're trying to decouple that as it's more of a subscription base, and that they're really changing their whole revenue model. And now the street's really going to look more at free cash flow and the uptake on Windows 10. So Microsoft, look, it's a transition quarter, going to a transitionary year. I think the street sort of looks past this quarter, which we call it.
You'd buy Microsoft now?
Oh yeah, I mean, I view Microsoft as a name on large cap tech compared to IBM and some of these other companies with no growth. Microsoft, best of the bunch. You could see multiple expansions, especially going to a Windows 10 product cycle. And you also have cost cutting and free cash flow that's now starting to ramp.
Is the software play no longer viable for Microsoft?
I think the jury's still out there in terms of where it's all heading. I think Microsoft does need to reinvent themselves. And that's, Nadella has looked in the mirror, realized what they need to do, and now it's about them slowly transitioning off PC. But that's not something that's going to happen overnight.
Very quickly, speaking of PC, a brutal one for IBM, another brutal earnings quarter, a 13% drop in sales, bigger than expected. Big Blue has not reported a year-over-year sales increase since the first quarter of 2012. What's your take on IBM?
I mean, this is an example of a company on the wrong side of IT spending. In terms of the traditional infrastructure, that's a massive headwind. And you have a CEO where it's a huge prove me, can they actually turn this around? They need massive M&A. And at this point, it really comes down to like what their next phase of growth is. But they've missed 14 of the last 15 quarters. And you even saw the Bulls throwing in the white towel today.
Right. A tough time for Ramity to be heading that ship. All right. Yep. Thank you so much, Daniel Ives, Managing Director and Senior Analyst at FBR Capital Markets. Stay with us on